Okay, so we're back to accounting. All right, so I'm looking forward to the long weekend. Anybody going home for the first time? There's always a few nods, yes. And I remember that too. In first year, second year, third year, I didn't go to school in the same town that I lived in, so going home at Thanksgiving was the first time I'd been home in a while, so always looking forward to that. Anyway, and we do have a long weekend, 4 days, because tomorrow is the day off here at Carleton, which is great. The other thing I like about Thursdays, does anybody watch Big Bang Theory? No? Yeah, gosh, that's so funny. Anyway, that's on tonight. I like that. I like that about Thursdays. Anyway, all right. Just a few announcements before we start. This isn't your course outline, but I think it deserves repeating at this time of the year. You have a midterm exam in this class. It's already been scheduled for Friday, October the 29th, 7 o'clock. The only thing that I didn't mention in the course outline is that it is 2 hours, so from 7 to 9. All right. It's on chapters 1 to 9 inclusive. All right. So that's everything we would have taken up to the week before October 29th. The structure of it, so far, I've got about 23 or so multiple choice questions. I'm not quite sure if I'm going to cut some or add some, I'm not quite sure. And at this point, I've got 4 questions, and I think it's going to stay at 4 questions. Anyway, and they're 4 long answer questions where you're just given a problem and an exercise very similar to what we've done in class or very similar to CNOW, and you answer on a blank piece of paper, that sort of thing. The rooms are to be determined. You generally don't get anything from scheduling confirmed until about a week or 2 ahead of time. So I will let you know. Okay, so I will post an announcement on WebCT. I'll mention it in class. So sections A and T do write all in the same rooms. It generally goes by last name. It is not in this room, however. Okay. And what I also tried to do too, because this is an accounting midterm, so I try to get tables as opposed to these little annoying tablets, you know, like what you're perching your laptop on. I will try not to get rooms like that. I try to get tables, you know, so you can spread out, put your calculator, you know, some pens, pencils, what have you, some paper, and manage that well. Okay. Because of the midterm exam, your TAs will be holding office hours very shortly. Okay, so not next week or 2, but 2 weeks leading up, anyway, to October the 29th, you will notice some announcements on WebCT about your TAs holding office hours. I myself, too, will also be holding extended office hours on Thursdays. So lots of opportunity there for you to ask questions. And I also, what I generally like to do is to come up with some sort of review, just problems from the textbook that I'll strongly suggest that you do in order to prepare for it. Of course, as always, prepare for any midterm by, you know, reading the chapter, redoing the problems we've done in class, doing the end of chapter demonstration problems, and as well the past problems that you've been doing. Please go to past, by the way. Did you have a comment, Dave, about past?
Yeah. Good morning. I just want, regarding the midterm, I just want to remind everybody.
No one at home is going to be able to hear this.
Okay. Want to come down?
Sorry.
No worries.
Yeah.
Morning. About the midterm, I just want to remind everybody that I'm going to be writing a mock exam that we're going to be taking up in past the week before the midterm. So your midterm is Friday the 29th. So during that week in past, we're going to have a take-up session for the mock exam that I'm going to write. And remember that I talked to Patty when I'm writing the mock exam, so hopefully she's maybe going to give me a couple of hints as to what to focus on. So keep an eye out on WebCT for a couple of announcements there. Just want to remind everybody. Yeah. I'm going to post it on WebCT on the discussion board as an attachment, as like a Word document. Cool? Any more questions?
All right. So yeah. So lots of ways to get prepared for the midterm, all right? And hopefully you understand that the best thing you can do is just practice, 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 practice. So practice the mock pass midterm, practice the questions we've done in class. Your CNOW, you know, you can go back and redo those CNOW practice questions. You know, try it. You've got lots of opportunity here for practice. That's the bottom line. So And you'll ace it. I know you will. If you're at all up to speed in reading the chapters and doing the problems, this won't be an issue for anybody this midterm. All right. So yeah, and TAs holding office hours, I'll be holding office hours, so lots of opportunity to ask any sort of question that you might have there. So, all right. I guess that's it for announcements. Oh yeah, the note taker for the PMC was found. So thank you, whoever that is. Thank you very much. And so those of you who are thinking about it, not quite sure, don't worry. We found a note taker for the Paul Minton Center students. So we're good to go. All right, so this week, it's actually a small chapter. It's not very long. We're going to be looking at fixed assets and intangible assets. Okay. We'll take a look, I guess, at the CNOW quiz later on. But just to let you know about what accountants are faced with in the real world, this is the office building that I work out of. Okay, so Canadian Horticultural Council, we're on the main floor, and up top is the Agricultural Institute, and that's my other accounting job. All right, so I spend part-time at the bottom, part-time at the top. And the Canadian Horticultural Council actually owns the building here in the land. Okay, and it presents a lot of accounting questions. All right, we constructed that asset, first of all. All right, so there is construction costs. All right, but some of the questions that crop up here are, what costs do we actually capture whenever we put the building here in the land on the balance sheet? All right, and we see a lot of different things here when we're looking at the building. And it's obvious, okay, the cost of the construction, that certainly will be put onto the balance sheet. So all that you see there, the windows, the doors, the bricks, and all the interior bits and pieces, definitely going to put those costs on the balance sheet. All right. Then there's a few things that pose a little bit of a challenge or question mark, anyway. So it's got a parking lot. You see that? All right. So it's paved. We get the lines repainted every so often. And the costs of the paving, as well, get captured into an account called land improvements. Okay? Now, that also brings up the question, do we depreciate it? We talked about depreciation earlier in our chapter on accrual accounting, but would you depreciate a land improvement like the parking lot? What do you think? Knowing what you know about accounting so far. So we established earlier on in the chapter on accrual accounting that we're not going to depreciate land because it doesn't get used up, but will we be using up the parking lot? Does it have a finite life? Yeah. All right. So I do depreciate the parking lot. There's also quite a bit of landscaping. All right. So there's little plants and whatnot around the building. There's actually trees on the other side. There's a patio that's off the kitchen. And there's this huge cedar hedge around the whole lot itself, right? So I've got trees, lots of plants. There's a sprinkler system that you don't see in there as well. Do I get to capture those costs and put them on the balance sheet? What do you think? Yeah, they've got a long, useful life. Yeah, certainly. And some would say you probably don't use up or will ever use up the trees and the landscaping and all of these other ones. So that particular land improvement, I will not depreciate. What about the sprinkler system? Got a long life, but does it have a finite life? Yeah. Yeah. So I will depreciate the sprinkler, and it's rather significant cost. So this is, what you don't see is there's a whole lot of land around this. This is in an industrial park near the airport, actually, the Regan and Terry's Drive. What else do we see here? Oh yeah, something recently that I had. Again, it just poses some accounting problems here. You see, the parging was redone on all of the steps and around the building because it was falling off, okay? And it costs quite a lot of money, okay? So it was like $5,000. I had the parging redone last year. Okay? What am I going to do with that cost? Is that an expense, or do I depreciate it over many years? Knowing what we know about accounting. Right? So a lot of questions here. All right? So there actually is a test about improvements such as this, like when you go to repair, replace something. We had the doors replaced too since this time. So this door has been replaced and the door along the back has been replaced. What do you do whenever you replace or repair something? Okay? That's what we're going to be covering in this chapter. The test is, does it extend its useful life or increase income? Yes, extend useful life or residual value or increase income. And I said, yeah, it would increase the useful life. Okay, if I repair the parging now, it's going to last a long time, and it will also protect the rest of the stairs. So I capitalized it. I added it to the cost on the balance sheet, is what I mean to say. What else is there? Oh yeah, in August we had a few severe storms. Every so often, and I don't know why, shingles fall off the roof. All right, so we've had shingles in on the back end of things. What about the cost of repairing the shingles? What should I do with that? Should I expense it, or do I add it to the cost that I have on my balance sheet? Is it going to extend the useful life? Increase income? First of all, it was pretty minor, so I didn't capitalize it. And it could be argued that, well, that's just regular repairs and maintenance. What other quandary do I have with respect to the building? Oh, yeah. This asset has gone up in value. Okay, so this asset was constructed about 9 or 10 years ago. Okay, and the land that it's on, has gone up in value. Generally, buildings go down in value, but because generally real estate increases as a package. This land and this building has gone up in value. Okay, since we constructed the asset. Do I get to record that new market value on my balance sheet? What do you think? What do you think? Yeah. Actually, that is something that's coming into play here in Canada, is this markup to market value. All right? So for certain companies, they can do that. All right? And more people find it more relevant. Okay? So when I present my balance sheet to my executive and finance for the Canadian Horticultural Council, my executive and finance committees, a lot of the questions that they ask, they look at my balance sheet and they say, but Patty, how much is the land and building really worth? All right? You keep depreciating the building, okay, and now you're showing it at about, I think it's net, it's probably about $800,000 or $900,000. But what is it really worth? Okay, so we did get an offer to purchase a few years ago, so we're looking at $1.2 million. They find that market value far more relevant, right? So these are all accounting type questions and challenges and things we have to deal with in the real world with respect to fixed assets. Right? So what do we include in the cost of the asset? What about repairs and maintenance or improvements? And what about market value? Right? And the other thing, of course, we've already touched upon is how do we depreciate such an asset? Okay, we know that we don't depreciate land, but we do depreciate things with finite useful lives. Right? So here we go. All right. So that's what we're going to be covering in this chapter, is all of these sorts of questions. Okay. So how do we account for the cost of fixed assets? So if I replace the doors, okay, because they were substandard to begin with, do I get to add that to the cost of the fixed asset? If I buy land and I have to pay a lawyer to settle the deal, do I add that to the cost of the fixed asset? We're going to look at computing depreciation, okay, using two methods, straight line and double declining balance. What happens if we sell a fixed asset, or we just write it off because of fire, whatever, it's destroyed? What about the depletion of natural resources, especially in Canada? Lots of industries and natural resources. And we'll look at intangible assets, okay, assets we cannot touch. Right? And how is depreciation expense recorded on financial statements, essentially. Okay? So long-term assets, what do we mean? It could be tangible, meaning you can touch it. So like the land and the building for the Hort Council, okay, or intangible, meaning you can't touch it, intellectual type property, okay, or goodwill. And so it has to be owned by a business and used in its operations over several years. Okay. So that's what we'll be focusing on in this chapter. And for a lot of businesses, especially in Ottawa, they have a lot of intangible assets. Right? They might have copyrighted some software program, right, or patented a particular invention. Right? What copyrights and patents do, and trademarks, is protect the owner from other people copying it. Okay? So copyright is protection so that people can't copy your book, copy your software, copy your music that you've written, okay? Or Usually it's works of art, works of original works that you don't want other people to copy. Patents, usually an invention, right? So I was watching Dragon's Den again last night. Somebody had this lobster thing. Did you see that invention? Just put the lobster in, it bands the claws. Anyway, and oftentimes you hear the dragons ask, do you have a patent on that? Right? So you register these things with the government to say, I don't want anybody else to copy that lobster banding piece of equipment that I've got. A trademark, that is simply protecting usually a phrase or a logo from other people copying it. Okay? So, you know, at the Horticultural Council, we've actually trademarked our name, Canadian Horticultural Council, along with our little logo, which is just a little maple leaf. But anyway, just so that nobody else can be that imposter. You know. Franchise fees, also intangible assets. Another one here that I haven't included is goodwill. Right? So whenever you buy a business for more than the market value of the net identifiable assets, you get to record goodwill. Right. So what do we put into the costs that we're going to show onto the balance sheet? Right. Well, we've got a cost principle, and that guides everything in accounting, especially on the asset side of the balance sheet. All reasonable and necessary costs incurred in acquiring long-term assets to place it in its operational setting and prepare it for use. All of those costs. Okay. So for, you know, you're buying a piece of equipment. My boss bought a laptop last week. One of my bosses bought a laptop last week. So she bought the laptop, and it wasn't just the cost of the laptop, okay, because she can't just get it up and going herself. So we bought it from, I think it was a Dell, anyway, and they charge shipping, right? So we had to pay for shipping, and the cost principle says, yeah, add the cost of shipping to that, okay? Now, we have to connect that laptop somehow to the network and install some software. So we had an IT consultant come in and do all of that work, okay, because there's really nobody in our office with that level of technology awareness or knowledge. So he spent a few hours getting everything configured, getting it connected to the network and the wireless up and running. So all of those costs contributed to getting that laptop operational, okay, and in use for my boss. What else? Any sales taxes, non-refundable sales taxes, so would also be included in there. Right? So purchase price, sales tax, installation costs, shipping or transportation costs, legal fees. Okay, if you're going to buy land, you probably will need to go through a lawyer, right, and pay for some legal fees. But generally not interest charges. Okay, so let's say we had financed that laptop. We can't add the cost of the interest to the cost of the laptop on the balance sheet. Okay? There is one notable exception about interest charges, though. If you're going to construct an asset, like we constructed that office, and if you were going to borrow money, you can capitalize the interest during the period of construction only. Okay? So that's it, that's all. Pardon me? Interest, generally not interest charges, okay, except one notable exception, and that's if you're constructing an asset. Okay, so the Canadian Horticultural Council constructed the office building. If we had gotten a loan to construct that office building, what you saw there, we could only capitalize interest during the period of construction. Okay? As soon as it was ready and we were given the keys by the contractor, we'd have to stop capitalizing the interest at that point. Okay. And you know, so for land, what would be included there is not just the purchase price, but any sales taxes that might apply on it. And in Ontario, actually the only tax that we see there is land transfer tax. Okay, that's a big one. And that's usually a percentage of the purchase price. If you had paid broker's commissions, okay, as a buyer, generally doesn't happen. That's usually paid by the seller. But if you paid a broker's commission, you would add that to the cost of the land. Any permits from the government, surveying fees. Oftentimes, you know, whenever we buy land, even personally, you buy land, you're going to want to have a survey done to make sure, okay, what exactly am I getting? Or the survey's got to be up to date, you know, in the last few years. And if you have to pay any delinquent property taxes, you get to add that as well. Right? I was reading the paper last weekend. The City of Ottawa is having a bit of a sale right now. There's a fair number of properties across the city where the property owners have not paid their property taxes. Okay? And so what the city can do is if the owners don't pay the property taxes, they can seize the property. All right, so there's a lesson. Always pay your property taxes. All right. So they seize these assets, and they're trying to sell them. And part of the process, you put in a bid. There's a minimum bid that they're looking for, but you have to pay all the back taxes on it. Right. So not only do you have to pay the purchase price, they're also asking for all the unpaid property taxes on that property. Okay? So it might be a deal for some people. All right. If you want to remove unwanted buildings, okay, you get to add that to the cost, less any salvage. So you get a little bit for, you know, the metal maybe that was in the building, the steel beams or whatnot. They're usually worth quite a lot. Grading and leveling. Okay, so grading just means, you know, you're how do I describe this? Just the lay of the land, okay, so that it drains well and whatnot. And if you have to pave a public street, all right. Right, so let's just take a look here at a quick example, and this has to do with acquiring land. Right, so Fastball Delivery Company acquired an adjacent lot to construct a new warehouse, paying $30,000 and giving a short-term note for $270,000. Legal fees paid were $1,425. Delinquent taxes assumed were $12,000, and fees paid to remove an old building from the land are $18,500. Materials salvaged from the demolition of the building were sold for $4,500. There's quite a lot of revenue in salvage, eh? I was out for a walk on the night before garbage day, getting off topic again, and there's this man that comes around our neighborhood with a truck and a little trailer, and he goes around, he's looking for metal, because it's worth quite a lot. So if anybody's thrown out any big metal pieces, he throws that in the back of his trailer, and he sells it for salvage. Right? So don't ever throw out metal. It's worth something, especially to this guy. So they've demolished the building. They get $4,500, probably steel beams. A contractor is paid $910,000 to construct a new warehouse. So determine the cost of the land. Okay? So what we're looking for here is just the land to be reported on the balance sheet. Okay, so knowing what we know about that. All right. So that's one of these items that we can include in the cost of the land. Anybody? No. The what? Legal fees paid, certainly. How much is that? 1,425. It's not bad. Yeah, delinquent taxes. Fees paid to remove the building? Certainly. 18.5. It's got to be more. That's a cheap piece of land. Right. We get to deduct the salvage value of what they got whenever they demolished the building. Right. Of course, the purchase price, we're missing the biggest part here. They paid $30,000, guessing cash, and gave a short-term note for $270,000. So looks like the total purchase price is $300,000. I forget to take out my calculator. What about the, we have everything. A contractor is paid $910,000 to construct a new warehouse. Do we include that? You know, what account does that get reported on under? The construction costs. That's going to be the building, okay, or the warehouse. There. So that's what's going to go on the balance sheet. All right. Yeah, it's usually too, I know at the City of Ottawa, whenever we constructed our asset, you've got to pay certain fees just to construct your building, all right? And you have to have certain deposits too. right? And I guess that's what's referred to here as permits from the government. Okay. So land development charges. Okay. I don't see any of those here because it's not the City of Ottawa. Right. So another issue that comes up, and I talked about it at the beginning of the lecture, is we sometimes repair, maintain, or even better our fixed assets or capital assets. Okay. And so how do we determine, do we add that to the cost of the balance sheet, or is that an expense that we're going to show on the income statement? Okay. So there are some tests here. So capital expenditure, what I mean by that is that would actually increase the balance sheet. So increase the asset, rather, on the balance sheet. So the test to determine should that be added or capitalized to the asset on the balance sheet is if it extends or increases the capacity of that particular asset. So, you used to have a paper machine at Domtar that could produce 100,000 paper rolls a year, and you overhaul that paper machine, and now it can make 200,000 paper rolls per year. And that would definitely be added to the cost of the asset on the balance sheet. Or does it increase the efficiency? Okay, it can still produce the same amount of paper rolls, but it'll do it in half the time. Right? So that's another test. Or does it extend its useful life? Okay. It's also another one that's sort of assumed here. Does it increase revenue somehow? Okay. So we may add this cost to the amount shown on the balance sheet. So it has to meet these tests. All right. Yes? Oh, so going back to the question. So they paid $300 and they have a short-term note. So the purchase price must have been $300,000. Okay. So they paid some cash and they signed a promissory note. That's what that means. Saying, oh, we'll pay you back soon. Okay. So that must have been the agreed upon purchase price. All right. Okay, so when we replaced the doors at the Hort Council and redid the parging, my take on that was that, okay, that's going to increase the useful life. Okay, those doors were substandard, right? We had gotten broken into, right? Because somebody could just kick it down. It was very poorly made in that area, anyway. And I thought, well, let's bring this up so that it will last. The 25 or 30 years that we expect a door to last. So we got steel doors, with certain kind of glass, in there that was better. So I added that to the building account on my balance sheet. Just felt it met the test here. Okay. But you can see where there's some gray area. Some people might say, oh, but Patty, you just replaced it. It's just an ordinary repair and maintenance. Okay. You haven't really extended the useful life that much, or that's arguable, that's negligible. Right. The other thing that we've done since we've had the building is taken two offices, a little meeting room and an office, and made a boardroom out of it so that we don't have to go downtown all the time to have our meetings, okay, when our members come into town. Right. So now we have this much larger boardroom. It did cost a little bit of money. We had a contractor in, had to take down some walls, add some things, electrical and flooring issues and whatnot. Okay. And so then again we had that quandary. Do we add that to the asset account, okay, all those costs, or is it just an ordinary repair and maintenance issue? Well, I'm saying, okay, it's adding here to the asset's capacity. Now we can have meetings, right? And we're going to save some money. It's not increasing revenue, but we're saving some expenses. And I thought it contributed to the increase in the building, so I added that as a capital expenditure. So those are capital expenditures. Ordinary repairs and maintenance, what I mean here is that we record the expense here on the income statement, and what that does is just maintain the asset, restores it to working order. So yesterday I had a handyman in. We have light bulb issues. Every few years, a whole lot of them just decide not to work anymore. Especially fluorescent lights, if you keep them on all the time, and we've got a fair number of those that are on all the time for safety purposes, the ballast goes on them and we have to replace them. Right? So he also replaced other bulbs. He went around throughout the building and he replaced bulbs everywhere, and he replaced a fixture as well. Right? And he'll be coming back to do painting in 2 weeks too. And I think that meets the criteria for ordinary repairs and maintenance, just keeping everything in working order. Okay. The other thing that a lot of businesses do is they say, okay, we've got these fancy definitions for repairs and maintenance, capital items, okay, but they might just put a dollar value on it. Okay. So something might meet the test of capital expenditure, but it's only $20. All right. Yeah, just expense it. Okay. So ours is, we've got a threshold. Anything $500 or more that increases an asset's capacity will capitalize. Okay. If it's less than $500, just expense it. It's not worth it, you know, taking depreciation on it. I know in the, depending where you are, it could be $1,000. Some businesses, I think the federal government is $1,000. It goes up, and even then, I think it depends on the department in the federal government. Right. So, depreciation. Not so new a topic. I think we've covered this in a previous chapter, but what we're doing here is just allocating the acquisition cost over its useful life. Okay. And we use a systematic and rational method, and what we did discuss in that chapter on accrual accounting is that we want to follow the matching principle. That's why we're doing this. Okay. So you've got an asset, you know, that we've got a building at the Horticultural Council. It's going to last decades. Okay, and in doing so, it's going to help us generate revenue for decades. All right? So what we'd like to do, remember, with the matching principle is we want our expenses to be matched to the sales that they give rise to. All right? So that's what we've accomplished by taking depreciation. Okay? We take this big asset we've got, this building. It's going to help us generate revenue for 20, 30, 40 years. Right? So let's take the cost of the building and amortize it, depreciate it over 20, 30, or 40 years. Okay, so on the balance sheet, and we've taken this as well, you'd see property, plant, and equipment. Equipment showing as $1,000, less the accumulated depreciation of $200. You get a value here of $800. That is referred to as the net book value or the carrying value. So how much are you carrying that asset on your books at? Well, right now, $800. And every time we do take depreciation, we're going to decrease our assets by subtracting from assets in this special account called accumulated depreciation. Right? So this is basically a review. This is a contra asset account. It's just shown against an asset account. Right? So that's why we're subtracting it. That's what the brackets here means. Right? We're subtracting. And depreciation expense on the other side of the accounting equation decreases retained earnings. Right? So that's what's going on. Right, so we've got some methods, right, which I don't think we got into any great detail at the, a few weeks ago whenever we looked at this. And by far, the easiest method is straight line, okay, where we take the same amount every year. Right? And how do we determine that? We look at the cost of the asset, how much have we recorded this on the balance sheet at, and we subtract out what's called a residual value. How much is this asset going to be worth at the end of its useful life? Right? And we have to come up with the best estimate. It is an estimate at the end of the day. In accounting, we do a lot of estimating, right? Because this would be really hard to quantify, with a lot of certainty. How much is that computer going to be worth at the end of 4 years? Be lucky to get $100 maybe for it. Give it away to somebody. Maybe it's zero. Okay? And oftentimes residual values are set at zero. I don't think it's going to be worth anything. Nobody will pay us money for that at the end of its useful life. It's not even worth anything with the scrap metal market. Right? And so what we do then is divide by the useful life in years. And this would be our depreciation cost every year. So if we buy a computer for $2,000 and we figure, okay, it's got a 4-year useful life, and at that time, maybe we can sell it to one of the employees for $100. We hope. All right? That's kind of optimistic. Right? The depreciation then that we'd take per year, in this case, be $2,000 less the $100 salvage value. We divide all of that by 4 to get $475 a year. We're just do it evenly over its useful life. And that makes it really easy to calculate out. Actually, yesterday I was in one of my offices, and we bought a capital asset. And so we've been talking about doing this for a long time. There are machines that fold paper, right? So if you can imagine, you can put a stack of paper into this machine, and it will fold it various ways, right? And everybody seems to be plagued by having to spend a lot of their time folding paper, whether it be brochures. Our communications person has to fold brochures, and it's the last thing you want to do at the end of the day. Our bookkeeper has to fold invoices, and usually she does a stack of them every month, and she looks at that and she's like, oh, I don't want to be bothered with this. Or we've got other people doing mail-outs for our annual general meeting, and they get a stack of paper, and they're like, oh, I don't want to be doing this. Right? So we've been looking around at machines that can fold and stuff into envelopes, and yesterday we decided, okay, enough. Folding already. We're just going to buy a machine that folds only, because it was not as expensive. So all told, all together, with the shipping and everything else, looking at an asset of about $1,000. And so what I often get asked is, well, can we afford that $1,000? Right? And what I have to point out to them is, well, we're not going to expense it all this year. Okay? This machine is going to last us 4 or 5 years, hopefully. All right? And so when you think about it, you've got a $1,000 machine. Let's say I'd amortize it, depreciate it over 5 years. What effect will that have on my income statement, assuming a salvage value of 0? About $200 a year, if that. Okay. Can we afford $200 a year expense on the income statement? Yeah. That's not so bad. Okay. So you have to look at capital assets that way. Okay, what is the effect on the income statement? Well, it's not as bad as you think. Right? So there's the straight line method. I've graphed it out for you, and lo and behold, if we look at the depreciation charge or amortization charge every year for its useful life, it is a straight line, right? 475. Okay. And this is a little depreciation table here, just showing our annual depreciation. Every year we take the same amount, 475. Okay. What's happening to the accumulated depreciation account? Well, it's going to get bigger and bigger, right? It's 475 at the end of the first year. At the end of the next year, it's 950. Okay? So accumulated depreciation keeps increasing here. Okay. So the net book value, what amount are we actually going to see then on the balance sheet for this computer? Well, at the end of the first year, 1,525, and it will keep going down. Okay? Until, look at that, that's our residual value. Okay. So if we take the $2,000, the cost of the computer, subtract out the accumulated depreciation at that time, you'll see that we've depreciated it down to its residual value. The big thing to keep in mind, too, about this whole depreciation process is I'm not trying to match the market value. So if I look at, okay, what net book value do I have? What value am I showing this on my balance sheet at year after year? This is not market value. Okay. It's not to say that, oh, at the end of year 1, you can sell it for $1,525. That's not the intent. Okay? Depreciation is just this process of allocating the value over its useful life. It is not trying to approximate market value whatsoever. Although generally, I do have to say, market value will go down over time. Yeah?
What if, say, someone wants to buy this thing and keep it for 100 years?
Yeah. So nobody will buy it for $100. You're hard pressed, and computers is difficult, right? You'd be hard pressed to even give it away to a recycler, right? Oh no, you can keep it certainly. Yeah, there's. You would just keep it on your books at $100. Yeah, indefinitely. As long as you still have it, it still stays on your books. As long as you're still using it, it stays on your books. Okay. Yep. Yeah, yeah. And you can have fully depreciated assets on your books. The only criteria, it sort of goes back to the definition of what a fixed asset is that you use it. It's in operations. Yeah, the net effect is 0. Okay, so the question is, what if you thought the residual value was 0? You depreciate it down to 0, okay, and you still use it. It just stays there. You still show it as cost item on your books, and you accumulated depreciation. The net is 0, and just keep using it with nothing showing really on the books. The net effect is 0. That's fine. We've got all sorts of fully depreciated assets on our books that we continue to use, right? But you have to disclose these amounts. Okay, so either on the face of the balance sheet, what a lot of people do is show it in a note, but you have to show your original cost of your assets in broad classes and the accumulated depreciation. Those two amounts, you just keep showing them, you know, and if it's fully depreciated, it's fine. Yeah. Yeah, so you made you've estimated useful life. You made a mistake, essentially. You didn't know. It was an estimate. You said, oh, I thought it would be used for 4 years. I've got a computer at home. It's 8 years old. My kids don't like to use it because it's really slow, but it still works. This is what I keep telling them, right? So had I been a business and depreciating it, and I think we've got some old computers in the office, right, that are fully depreciated, you know, but they still work. They're still, we've got printers that are more than 5 years old. Our fax machine is ancient, but it still works. You know, we get to the office every morning, there's faxes in it, great. All right, so we made not an error. We used our judgment, and we said, yeah, we think that equipment is generally going to last 4 or 5 years. If it lasts more than that, okay. So it is. All right, good questions. Okay, so that's straight line. All right, so graphed, it's a straight line. The other thing, too, that I want to point out is you will see the word amortization expense and depreciation expense used interchangeably. They mean the same thing. Okay, so it does not matter. This book, though, says depreciation. All right, so double declining balance method. This is a different method. We're going to take a lot of depreciation in the first few years, first years anyway, of the asset's life, and then not so much later on. Okay. And this might be a good method, right, for some assets. So if we go back to our last example there, let's say the estimated useful life of that computer is 4 years. Okay. So we would take the straight line depreciation rate, which means we would depreciate 1/4 of it every year, right? 1 over 4, 1 over the useful life in years. All right. So if I said, oh, the useful life is 5 years, then that would mean that the straight line depreciation rate is 1 over 5. Or if I said, oh, 6 years, the straight line depreciation rate is 1/6. Okay, so 1 over the useful life in years. And I express that as a percentage. Okay, so I can take that 1/4. What is that in terms of a percentage? That's 25%. Okay. Actually, I was just working on this with my daughter the other day. This is grade 6 math. Taking a fraction and converting it to a percentage. You then double that rate. Okay, so we've got the 25%, double it. So your 25% becomes 50%. Right? That is the amount then that we're going to multiply by the capital assets net book value every year. What does that mean? Let's go take a look. So let's say we have a machine, costs $10,000, has a useful life of 4 years. So first step, what's the straight line rate? Well, I put 1 over the 4, the useful life in years. And I get 25%. Okay, converted that. So I double that rate. Okay, I can do that in my head even. That's 50%. I then take that percentage, multiply it by the net book value every year. So first year's depreciation, if I bought the asset for $10,000, multiply that by 50%, that means my depreciation in the first year, $5,000, half of it. That's pretty significant. The next year, okay, I multiply the 50% by the net book value, but the net book value now has changed. Okay? Net book value is always this original cost less the accumulated depreciation, which at this point is now $5,000. Okay? So my net book value is $5,000, 10 minus 5. If I multiply that by 50%, it means year 2, 2,500. Okay? So it's less, and quite a hit. First year, 5,000. Second year, 2,500. Wow. Year 3, take depreciation again, use my 50%, but I've got a new net book value now. Okay. So 10,000, the original cost. My accumulated depreciation now has 2 amounts in it. 5,000 from the first year, $2,500 from the second year, $7,500 in accumulated depreciation. That only leaves a net book value of $2,500 there. Okay, 10 minus 5 minus 2,500, only leaves 2,500. So I multiply that by 50%, get 1,250. So quite a big curve, eh? If we were going to graph that. Big chunk of depreciation the first year, a little bit less the following year, even less the next year. Right? You'll notice here we have not used, in any of our calculations so far, residual value. Okay? It had nothing to do with any of these calculations or anything. But it does still have a bearing. Okay? We're not going to depreciate below the residual value. Okay? That's important to know for your See Now quiz. That does come up. Right, so let's take a look at the depreciation schedule in this case. So what is the depreciation expense every year? Well, that's changing. We determined on the last slide, first year, $5,000. Okay. Accumulated depreciation, well, we only have the one charge, so that's $5,000. That leaves a net book value of $5,000. Okay. The $10,000 less the balance in the accumulated depreciation account. Oh, I can't spell today. All right, next year, I take a look at my net book value. It's $5,000. Right? Multiply that by 50%. There's my $2,500. My accumulated depreciation, well, I'm adding $2,500 to that previous balance. So that's where I get the $7,500, the $5,000 plus the $2,500. So my net book value, a little bit less now. Okay. Following year, I take my net book value, multiply that by 50%. I'm looking at depreciation expense of only $1,250. That's going to increase accumulated depreciation just a little bit more. I take last year's, add 1,250 to get 8,750. Net book value, even less. Okay? You see the way the numbers are flowing here? Next year, I take my new net book value, multiply that by 50%. My depreciation charge this year, $625. Okay? That's going to increase the accumulated depreciation just a little bit more. Net book value, $625. Will it ever get to zero, do you think? No. All right. Because something of something, 50% of something is still something. Right. And so the thing to keep in mind, as I mentioned earlier, don't depreciate below the residual value. Okay. So if somebody said, oh, the residual value is $312.50, we would stop at this point. Okay. We wouldn't continue to take depreciation in year 6. All right. So if we were to graph it, we see that we get close to zero, never going to touch zero in terms of that book value, that net book value. All right, so just in summary, how did we calculate these amounts? So straight line, the depreciation charge, the calculation there, cost less residual value, divided by useful life. We're going to get equal amounts each year. Double declining balance method. This is from the textbook. This is how their take on it is. Cost minus accumulated amortization. That means net book value, by the way. Times 2 over the useful life. Well, what's that? So that means if you took 1 over the useful life, as we had done earlier, and multiply by 2, you get the same thing. Right? Means the same. Then that's declining amounts over time. So how do you determine which one you're going to use? All right? You have choices. So you see, accounting is not an exact science. We're making an estimate on a lot of things here. Residual value, we're making an estimate of useful life, and we can be wildly wrong, okay? Wildly wrong. And we have a choice, too. So if you gave, the same asset to 2 different businesses, you're going to have different amounts of depreciation. I can guarantee it. This is not an exact science. They will not come up with the same amount, because they're going to make those 2 estimates, useful life, residual value, and then they're going to decide on their own what method of depreciation they'd like to choose at the end of the day. So consider the differences in the bottom line, okay? But I think what's more important is, of course, the matching principle. Okay, do you have an asset that's going to generate a lot more revenue for you in the first few years? Well, then maybe you should take the double declining balance method. Okay, maybe that's the one you should choose. If you have an asset that is going to give you revenue rather evenly over its useful life, you might want to consider straight line. Another consideration is the Canada Revenue Agency rules. Okay, they do allow only for tax purposes the double declining balance method, but they set the rate. Right. Actually, it's a maximum rate. So they'll say, oh, that's class 8. They put assets into large classes. It's class 8, that's class 12. And they give you the rate. It's 30%, it's 20%, it's 25%. That might sway some people. All right, so we'll do a problem from the textbook. New Birth Coatings Company purchased waterproofing equipment on January the 2nd, 2009 for $380,000. The equipment was expected to have a useful life of 4 years, residual value of $36,000. So determine the amount of depreciation expense for the years ended December 31st, 2009, 10, 11, and 12 by 2 methods, straight line and the double declining balance method. Also, determine the total depreciation expense for the 4 years by each method. The following columnar headings are suggested to record depreciation. Oh, okay, whatever. I'm just going to set it up similar to, there we go, this, okay? So the year that's ending, how much is the depreciation expense that year? What is my accumulated depreciation? And what is the net book value? Okay, so they buy the equipment January 2nd, and they want to know, of 2009. They'd like to know the depreciation expense for the year ended December the 31st, 2009. That's essentially 1 year. It's 1 year less a day, but are we going to worry about the day? No. Okay. In accounting, we often look at that. Well, what's really material? Is the 1 day? No, it's not. So how do we calculate straight line depreciation expense then? What's involved here in my calculation? You are responsible for memorizing that part. Yes. Cost minus right. 36,000. And useful life is 4 years. Okay. So, just as an aside, and here I go again off topic, you are responsible for a fair bit of, calculations, okay? But whenever we get to a chapter on ratios, I will be providing those formulas. Okay? So, they become more relevant once you get to chapter 9. This formula you will need to know. Right, so I'm getting $86,000 a year. So we'll just complete it. Accumulated depreciation at that point will be $86,000. The net book value, that's always the original cost, less the accumulated depreciation. So it'd be the $380 less $86,000 at this point. Okay. Is that making sense? Continue on the next year, because they wanted depreciation expense for 4 years. It is straight line. It is the same amount every year. Actually, that makes the rest of it really easy to finish, eh? $86,000. $86,000. And what that means is accumulated depreciation goes up by $86,000 every year. 258. And that means net book value goes down a little bit more every year. And I guess it's no surprise that at the end of the fourth year, December 31st, 2012, the net book value agrees to the residual value, right? Because we're only going to depreciate it down to the residual value. Right, so they wanted to know, determine the total depreciation expense for the 4 years by each measure, or method, or whatever. So how much is the total then of depreciation expense? Still see that? Total depreciation expense. I guess it's 86,000, right, times 4. There you go. Right. So we also have to do it by the double declining balance method. So this is only the straight line method. Any questions on this before I go on to the next method? All right, so same columns as last time, but the calculations are quite different. In order to calculate the depreciation expense, what's my first step? Double declining balance. Double the last one, right? So let me just go to another page here. I put 1 over the useful life in years. So this is my straight line rate. I convert that to a percentage, and then I double it. Right. So that's the rate that I'm going to apply to the net book value every year, 50%. Okay. So far, residual value's got no bearing, but we will not depreciate below residual value. We'll stop before we get there. So depreciation expense, that's where that 50% comes in handy. 50% times the net book value. Well, whenever they first bought it, that is the net book value, the original cost. It's at $380. Wow, $190,000, all in the first year. That's half of that, the cost of that, what is it, waterproofing equipment. Right there. So accumulated depreciation, well, we've only got 1 year's charge, so 190. The net book value, remember that's always 380, the cost of the machine, or the equipment, less the accumulated depreciation. So 380 less 190. That's 190. Next year ending, December 31st, 2010. Take the 50%. We're always multiplying that by the net book value from before. Well, we ended up at 190. That's 95,000. So that means accumulated depreciation is going up, 285. So I took the old balance. I add $95,000 to that. I get 285. I'll spell that out. What does that mean for net book value? 380 less my new accumulated depreciation. Wow. So a lot of expense happening in these first 2 years. The asset went from 380,000 on the books to 95,000. Whoosh, all gone. So that's going to leave less to take in the next 4 years. So we have 50%. At this point, the net book value is 95,000. So the depreciation expense for this year, 47,500. That's going to increase this a bit. It was 285. So net book value, not leaving very much. So this is 380 less the 332.5. Now we have to keep in mind the residual value is $36,000. So next year we're going to have to be really careful that this net book value doesn't go below 36,000. Okay? So it can't be less than 36,000. Not allowed. So when we go to do this calculation, let's just keep that in mind. We'd ordinarily take 50% of 47.5. So let's just see, well, what will happen if I do that? I get 23,750. Well, that means that that's way too much for accumulated depreciation. And yeah, I have depreciated it far too much. So if I would take just a regular charge, 50% of the net book value, and I just follow the numbers through, that means my net book value goes down to 23,750. We have to stop before we get there. We can only depreciate down to $36,000. Okay. So, working backwards, that means even though the calculation says that we should take depreciation at 23,750, we're actually limited there. We can only take 11,500, just working backwards. This has to be 36,000. Okay. Meaning this can only be 344,000. Okay. Meaning we can't take 23,750. We can only take 11,500. Okay. That's a caveat there. Can't depreciate below the residual value. And that's generally going to happen in year 4. Okay? We said the useful life is 4 years. It'll occur around that time. It might happen actually for some assets in year 3, year 4. Pay attention to it, okay, as you get closer to the useful life. If we take a look at the depreciation expense total over the 4 years, what do I get here? 47,500. Look at that. It's still, in total, 344,000. They had also asked for that. Determine total depreciation expense for the 4 years by each method. It's the same in total. It's just how do you take it? You want to take more at the beginning, equally? Which way do you want to do that? Okay. Any questions on that? No? Good. We shall keep going. So in that last example, you notice they bought the asset January the 2nd, which was conveniently the beginning of their fiscal year. I can tell you we do not buy assets only on the beginning of a fiscal year. We buy assets throughout the fiscal year. Okay? So I just bought a folding machine. And my fiscal year ends October 31st for that company. So what am I going to do when I go to calculate depreciation on the folding machine? So what's generally done is you multiply the annual depreciation by a fraction of the year that the asset is held. Okay, so if annual depreciation is $12,000 and you only wanted to take depreciation for 1 month, just take 1/12 of that. Okay. Now, I know this contradicts a little bit of what we see in the textbook. I think they say, oh, we adhere to the half-year rule. You take 50%. Okay, that's the American way of doing it. In Canada, you'd actually take depreciation of 1/12. Okay. You could also be more precise, too, if you wanted to. You could do it by days, right? You could, instead of saying, oh, we've held that asset for 1 month out of 12, oh, we only had it for 10 days of 365 days. You can do that, too. How precise do you want to be? All right. Another transaction that can occur is disposing of a capital asset, which happens. So it might be sold. Right? So you know, at one of my jobs, one of the computers actually that I was using had gotten to the end of its useful life. It was 5 or 6 years old. The speed had gotten slower and slower. You know, that happens. I don't know why. Why does the speed get slower on older computers? Like, what's going on? Anyway, done the defrag thing. I don't know what was going on. But I thought to myself, hey, this computer is only 5 years old. It's better than that 9-year-old or 8-year-old computer I have at home. My kids will be so happy. So I asked my boss, can I buy it? Right? So I did. Brought home a computer last Christmas. Right. So they sold the asset to me. So I paid $50 for the computer. It also could be that the asset may not be used in operations anymore, and if that's the case, you have to take it off your books. Okay, that is the very definition of capital assets. It must be used in operations. So if you've got an idle asset, for whatever reason, if you're not using it anymore, take it off the books. Or it just might be destroyed. Right? So you have a flood, you have a fire, or something happens. Right? So 3 steps. First of all, you bring the depreciation up to date. Okay? So 3 steps, what I mean is that. 3 steps to take the asset off the books. First of all, bring the depreciation up to date. So when did you last take depreciation? Okay, and figure out what is left, okay, to bring it up to today's date. And that's the other thing too. What we saw here in this problem is they seem to only take depreciation once a year. Okay? But in the real world, we're going to do it a little bit more often than that. Okay? I do it quarterly for one company. I do it monthly for another. Right? So you want to always keep these up to date. But there will be a point where if you do sell an asset, don't use it, or it gets destroyed, you have to bring your depreciation up to date. And so then take a look at that book value, or the net book value, this amount here, what's left after you've taken depreciation, subtract it from the cost of the asset, and compare that to the proceeds of disposition. What do I mean by that? How much cash did you get? Okay, if you sold it, how much cash did you get? If it's destroyed and you got insurance proceeds from it, how much are the insurance proceeds? And then you compare those two values to determine, calculate if you have any gain or loss. You might end up even, but I doubt that. Okay, so example. Chancellor Industries owns equipment that costs Catherine Chancellor $6,000. She looked at that, she said there's no residual value. Estimated residual value is 0, useful life is 10 years. On December 31st, 2010, the accumulated depreciation balance, $4,750. Okay? What we're not being told here is what's the net book value? Well, that would be the original cost less the accumulated depreciation. What is that? 1,250. On March 31st, 2011, the equipment is discarded. Okay. Just tossed out. Not going to be used anymore. So, first of all, bring the depreciation up to date. Okay. So, she'd been using straight line depreciation. Okay. So, we know that in order to calculate straight line depreciation, original cost less residual value. She said, oh, it was worth nothing. Divided by estimated useful life. Okay. Now, because she used it for the first 3 months of the year, we're going to take that annual charge, multiply by 3/12. Because it was on April the 1st, right? They threw it out. March 31st. Okay, so we have 3 months to bring the depreciation up to date. Because we only know the accumulated depreciation to December 31st. So when I do that, I get $150. So the accumulated depreciation has now got a balance. This is for the first 3 months of 2011, and this was to December the 31st, 2010. Okay, so to the end of March 2011, accumulated depreciation is $4,900. I can now compare the book value to the proceeds of disposition. We bought the asset, she bought the asset for $6,000, accumulated depreciation is $4,900. It's $1,100 that's sitting on the books. Catherine Chancellor, she just threw it out. She got nothing for it. 0 is the proceeds of disposition. So she's got to show a loss on her books of $1,100. Okay, what she's doing is she's taking the asset off the books. She's got no cash to compare it to. Okay, so what's going to happen in her accounting system? Okay, so first step, bring the depreciation up to date. That's what we are doing here on line number 1. Okay. So that was for the first 3 months of 2011. Accumulated depreciation, minus 150. Depreciation expense under retained earnings. Okay. Then to record the disposition of the asset, what we want to do is show no traces of this asset on the books whatsoever. So it's sitting under equipment for $6,000. We want to remove it from that equipment account. So we're going to subtract $6,000 from equipment. You put it in the garbage, right? There's nothing there. So take it off the books. Accumulated depreciation, that generally has a negative balance. So if I add, that's what I'm doing here implicitly, $4,900, it'll get removed from the books. Okay. And we've already calculated the loss on disposal, $1,100. That does decrease retained earnings. Okay. So on this side, the net effect, negative $1,100. The other side, negative $1,100. We've done the right analysis. Okay. This loss on disposal, as you would expect, goes to the income statement. Okay. And usually under other operating, below operating income. Because disposing of assets isn't generally part of the regular line of business, okay, for Chancellor Industries. It's not what their main line of business is. I don't know what it is, actually, that she does. Any questions on this? All right, so we'll do an exercise just like it. Equipment acquired on January 3rd, 2007 had a cost of $265,500, has an estimated useful life of 8 years, estimated residual value $31,500. So then we're asked various questions about that equipment. What was the annual amount of depreciation for the years 2007, 2008, and 2009 using the straight line method? Okay. Well, we just did something very similar to that, right? We know we have to take the original cost, $265,500, subtract out the residual value, $31,500, and divide by years of useful life. So I get $29,250. So that'll be the depreciation expense every year. All right, well, that was easy. B, what was the book value of the equipment on January 1st, 2010? Okay. So we've depreciated it for 3 full years, right? 2007, 2008, 2009. So at the beginning of 2010, they want to know what is the book value. know it's going to be the original cost less the balance in the accumulated depreciation, which at this point, it's for 3 years, right? 2007, 2008, 2009, so it's 3 years. So I'm getting 177,750. So 3 days later, assuming that the equipment was sold on January 4th, 2010 for 168,500, illustrate the effects on the accounts and financial statements of the sale. So they're taking us through all the steps, like I had itemized them on a previous slide. But first thing first, bring the depreciation up to date. We did that. Compare the book value to the proceeds of disposition. Well, if we sell it for 168,500, unfortunately that's a loss. You've got it on the books at 177,750. You only sell it for 168,500. You've got a loss then 9,250. So we'll take that amount, illustrate that transaction, the effect of that transaction on the accounts and the financial statements of the sale. So, what does that mean we have to do? Right. This should be really familiar to you. Assets equals liabilities plus equity. We're getting some cash. We know that that's going to be affected. Right? 168,500. And I want to remove this asset completely off the books. So under assets, I probably have an equipment account, and I want to just get rid of that. And I know that I had originally set up that equipment at 265,500. So I'm going to subtract it out of the account. Right. Where did I get that amount? It's just right at the beginning of the problem. And as well, oh, and I'm running out of space, but I want to also remove it from the accumulated depreciation accounts. Okay, this is also an asset account. All right, so things aren't lining up exactly right. This is an asset. And my accumulated depreciation, I'm just going to go back to the previous piece of paper here. What do I have here? 3 years. 87,750. Okay. So if I've taken depreciation expense of the same amount for the last 3 years, my accumulated depreciation account will have a balance of negative 87,750. Okay. So if it's got a negative balance and I want to remove it, the effects of this equipment off of it, I have to actually add it. Right. So under retained earnings, here's my loss, 92.50. I just want to make sure that I'm adhering here to my math rules. Just want to take a look at what is the net effect on this side of things. Yeah. So the net effect of all of these three amounts is negative 9,250. So we're good. Right. Any questions so far? Yeah? Yeah. So, yeah, if you're doing your little See Now income statement, it's, loss on disposal. And the See Now quiz takes it a little bit further, right? And you also have to show, I guess that would be important to show, what are the effects on the cash flow statement? Okay. And so far, a lot of what we've been doing is operating, right? It's got to do with the regular line of business. Okay. But if you sell an asset, right, I think I just said, this isn't your usually regular line of business. This is an investing activity, okay? And we are getting cash here of 168,500. Okay. So anything relating to capital assets, buying and selling, that's investing activities. Operating is just your regular line of business. Financing, that has to do with long-term liabilities, which we'll get to next week, and shareholders' equity, which we'll also get to next week. So this is a new category on your cash flow statement, investing, because it has to do with capital assets, long-term assets. All right, so that was C. Doesn't look like we're done yet. Here. D, assuming that the equipment was sold on January 4th, 2010 for $180,000 instead of $168,500, illustrate the effects on the accounts and financial statements of the sale. It's going to look a little bit different, except when we go to compare the book value to the proceeds, now this is going to be 180. If we sell it for more than the book value, we have a gain. So similar accounts, cash, equipment, and the accumulated depreciation on the equipment, and retained earnings. This time though, cash is going up by $180,000. I still want to remove any trace of this equipment off of my assets. Okay. So equipment, it's sitting there at $265,500. I want to subtract it, $265,500. Under accumulated depreciation on the equipment, I've got a negative balance of $87,750. I want to add then $87,750. Okay. And I also know that I've got a gain on sale. That will increase my retained earnings. Any questions on the math? Good? All right. Okay. And something that's not covered in the book whatsoever, but I thought I'd just make mention of at this point, is in regards to capital assets. Okay. What we've seen so far is that the cost that we capture, okay, the amount that we capture on our balance sheet, the $265,500, is all the costs, we adhere to the cost principle, so all the costs of getting that equipment installed and ready for use. Okay. And we'll keep it on the books. We've been told, this is what the textbook tells us, what Patty just told me. We'll keep it at $265,500 and continue to depreciate it over time, okay, using a systematic rational method. So straight line method or double declining balance. There are others, but that's all we're covering in this class. And generally that's been Canadian GAAP, or generally accepted accounting principles, forever. Okay, we adhere to the cost principle. There was one little caveat, impairment. So if your asset for whatever reason is impaired, or it's got a serious and permanent impairment, then we're going to write it down to its impaired value, all right? And that just goes with any asset whatsoever. But lately, because of something called IFRS, we're going to be having an option to record equipment, capital assets, land, what have you, at market value. Okay, so this is all coming up for public companies starting January 1st, 2011, which is really soon. Right? They're also giving this an option to private companies. Right? So they're coming up with a whole new set of GAAP rules for private companies, which essentially is the old GAAP. But they're saying if you want to, you can adhere to IFRS, International Financial Reporting Standards. Okay? Because that's what the rest of the world does. Because if you can believe it, Canada's got its own rules, so does the States, okay? So does Australia, so does the European Union. Everybody's got their own rules. And they're saying this is really confusing. You've got investors who want to invest in companies. They look at a balance sheet, and the valuation can be completely different. So why not all be on the same page? So what's coming up is IFRS, International Financial Reporting Standards. And so my father actually sent me something, an email last week. He said, get this, RioCan, they're a big company. Not a company, they're actually a real estate income trust, but I'm not going to get into that. RioCan owns a lot of real estate in Canada, right? And they're coming up on IFRS, okay? And because they are publicly accountable company, or income trust in this case, organization, they will be writing up their assets. This is a news brief he sent me. Under the new rules, RioCan's assets will gain $1.6 billion to $6.9 billion. All right? So if you took a look at RioCan, you took a look at their assets for this year, okay? What is it? They would have a value of $5.3 billion. Okay? But effective January 1st, 2011, they're going to write them up to $6.9 billion, because this is the market value, and this is an option now. Okay? Publicly accountable companies, in this case RioCan, because they are what they are, they can adopt these new rules, right? And that's quite significant, right? So their assets are going to go up by $1.6 billion. Right? So if you're a user, an investor of RioCan or potential investor, you look at that, wow. All right. So they've already, so I'll just read you the whole company news alert. So being proactive, RioCan REIT is the first out of the gate to announce the effect of new accounting standards, or IFRS, on its book value. Right? Under the new rules, RioCan assets will gain $1.6 billion to total $6.9 billion. Wow. For those of you who don't know, the IFRS rules come into effect in Canada on January 1st, 2011, but have already been implemented in Europe, and they require firms to record assets at fair value, not historical book value. These changes will make sure market fluctuations are accounted for. That's a little bit misleading. This is actually an option. No, you don't have to do this if you don't want to. Okay? But for RioCan, they've decided, yes, this is more relevant information. We're going to increase our assets to market value of $6.9 billion. Wow. Okay, so they've got a few options, it says here. They can continuously update their book values, okay, by running appreciations or depreciations through their income statements. Other firms will simply run the IFRS valuation as a separate model and disclose the number in their notes. The third option, which RioCan used, allows for a one-time big increase and then further disclosure in the notes to their financial statements. Okay, so I think it's going to affect the users. You know, they're going to take a look at that and say, oh, what happened? You know, it's something else. So they did a survey of European countries, and they said, well, how many companies actually wrote up their assets to market value when given the option? And it was less than 10%. Okay. All right. Okay, so other topics, I think I can just finish up the chapter here that are covered in this chapter. Natural resources. Okay, so for a lot of Canadian companies, huge. Right? You acquire natural resources. So, and usually it's rights, right? So drilling rights, right? Or forestry rights. Okay, so you've got a tract of land, you've got mining rights perhaps for that, or you know, you can cut down a whole lot of trees. You can record on your balance sheet the cost to acquire the natural resource. Okay? And generally it's the cost of the rights. And you record depletion or amortization on that. So as you mine the ore, the iron, or the coal, or you cut down the trees, or you drill for oil, you're going to deplete that asset. You're going to just decrease it. Okay? So Petro-Canada pays $3.2 million for the rights to remove 80 million barrels of oil in the ground. This year they removed 40 million barrels of oil. Okay? We calculated depletion rate, okay, the cost of the rights divided by, okay, the total find was, that they figured was 80 million barrels of oil. So that'll be 4 cents a barrel. And depletion for this year, multiply the rate by the amount of barrels of oil that they've taken out of the ground. Okay. So it's very similar to amortization or depreciation. We'll have an entry here to accumulated depletion. On the other side of things, depletion expense. The other assets that we generally see on balance sheets are intangible assets. Okay? It's usually got to do with intellectual property, like patents, copyrights, trademarks. Could also be goodwill. Get into that in another slide. Right? So yeah, they're accounted for similarly to fixed assets, except we amortize them. We don't depreciate them. Okay? So there's quite a lot of difference between what you're going to read in your textbook, because it's American, and what is going on here in Canada. So let me just be absolutely clear what's the Canadian take on this. Patents are, it's a protection of an invention. Okay? So when you register this with the government, okay, it's through Industry Canada. They've got a, what is it called? Canadian Intellectual Property Office. Okay? And they, if you want to patent something, you've made an invention, maybe you're one of the people presenting at the Dragon's Den, they can give you protection for 20 years, okay, saying that only you can exploit the invention for 20 years. And after that, other people can copy you, okay, but we can only protect your patent from other people copying you for 20 years. Right? And you have to apply for it. There's a little process. And the costs of applying and securing your registration, okay, and so any legal fees that you might incur, you get to put on your balance sheet. Okay? And so, this is a legal life. But you've got options when it comes to amortizing. You want to amortize the cost of setting up your patent. You have to look more at useful life. So how long do you think you're going to be exploiting this patent for? It might not be 20 years. It's probably less. You'd probably think, well, it's got a 5-year life. Okay, I'm going to sell as many units as I can, but after 5 years, it'll be due to obsolescence, it'll be worth nothing. Okay, so it's usually you'll amortize over its useful life, which is usually less than 20 years. Okay, the other piece of intellectual property that we can register, it's with the same office. The Office of Canadian Intellectual Property Office is a copyright. Okay, so you write a textbook. Do you feel like writing a textbook? You write a piece of music, okay, a sound recording, right? You're in a band and you got a sound recording. You can copyright it so that nobody else can exploit it for profit. You write a computer program, right? You can copyright it. Right? So again, it gives you protection for all of your life. Nobody can copy your piece of music, your program, whatnot, but it'll go beyond your life for 50 years. So all of your heirs can also keep exploiting it. That is the legal life. Right? Then after 50 years after you die, people can start using your piece of music or program, and you are not protected anymore. And we can amortize the cost of setting up the copyright and any legal fees associated with that over its useful life, which is not necessarily the legal life. Okay? And you are allowed to amortize that. The last bit is a trademark. Again, you also apply to protect a trademark, which is generally a phrase or a logo. Right? So there's lots of logos here. Grandin Toy's got, just looking at my pen, it's got their logo, Grandin Toy, and it's got this little circle at the end of it. I don't know if you can see that, but that's a trademark. Okay, it either says TM or R, just meaning they've registered that with the Canadian Intellectual Property Office. The logo here for, here's my calculator, Texas Instruments. Okay, they've got a little logo for Texas Instruments. That probably has a trademark on it. Actually, I know that if and as well, the name of my calculator is called BA2+. It's got a little TM there. There's a trademark even on that phrase. Okay. At the Canadian Horticultural Council, we have a trademark on our name and our little logo, a little maple leaf. Okay. And the cost of registering your trademark, you can put on your balance sheet. Okay. The legal life of a trademark in Canada is 15 years. Okay. So I've got this trademark on the Canadian Horticultural Council's balance sheet. It's not worth a lot. It was about $9,000 just in legal fees and registration fees to set up. Okay. You can't capitalize the cost of it, unfortunately, of developing it. Right. So then I was asked by my auditor last year. He said, "So how long are you going to amortize it over?" And I said, "I'm not." Because the useful life is longer. Because to me, the useful life of a trademark for the Canadian Horticultural Council is actually indefinite. So I'm not even going to take amortization on it, saying, "Oh, we're not going to write it off whatsoever." Okay. So the interesting thing about a trademark is I can apply for re-registration at the end of 15 years. And I can say, "Okay, I want another 15 years protection." I can keep going back because I'm going to continue to exploit that. All right, so amortization, yes, we can take amortization on these items. Okay. We're going to match the cost of the intangible life with its useful life, not necessarily legal life, but it could be the same. Okay. All right. Yeah. So very similar to straight line depreciation. Patents is just an example. This is the American part of the textbook, right? Did I caution you? So assume a company acquires patent rights for $100,000. The remaining legal life of the patent is 14 years. However, the company feels the remaining useful life is 5 years at this time. So they'll only amortize it over 5 years. Goodwill. Now, goodwill is something we purchase. Okay? So whenever we buy something in excess of its net identifiable assets, okay, the market value of that, we create goodwill. We have purchased goodwill. So why would you do this? Okay. So my brother-in-law is in the midst of buying a restaurant, okay, not here in Ottawa, and he is buying assets and some liabilities of this restaurant, and he has to assume some of the liabilities, and he's got a market value, and I'm just going to put numbers. Make them really low. Let's say the assets of his restaurant are $100. He's assuming liabilities of $10. So, and this is the market value. So the market value of the net identifiable assets in this case, $90. But my brother-in-law, I can tell you, has actually offered the owners more than $90. Okay? Let's say he offers, I don't know, $115. He's paying $25 more than the market value of the net identifiable assets. Why would he do that? Yeah? Secured a bid on it, yeah. But he must feel it's worth more than that somehow. Why would he feel that it's worth more than what's identified there as $90? Maybe he's not too bright. Maybe he hasn't taken accounting. Why would he pay more for that? Buying a restaurant for more than the market value of the net identifiable assets. Why would anybody do that?
It'll go up.
Yeah, he thinks it's going to go up. It's got potential, earning potential. It's a great location. There's a really good cook that's on staff there. Right? There's a good customer base. It's on the main street of a little village in southwestern Ontario. Okay? And the neighborhood is booming. Right? Lots of retirees moving into this little village, okay, in southwestern Ontario. So he's paying more because of that, all these sort of intangible things. And we call that goodwill. He's buying the goodwill of the business. Okay? The great location, the income potential, future earnings. This town is set to boom. All right? Okay, so he can record on his books whenever he buys it, and he's opening November the 1st. He's going to have goodwill, in my very simplified example, of $25. Okay, he's bought goodwill. So, the thing about goodwill is that you don't amortize it. See that word? Not amortized. Okay. But you do have to do something every year, and it's usually done at the end of the year. You're preparing your year-end financial statements, and you'll look at the goodwill account and you'll say, is this impaired in any way? Okay. So how are you going to determine that? Well, if your name has been sullied for whatever reason, right? Say you're Maple Leaf Foods, okay, and they've had quite a lot of difficulties. with what is called listeria at their meat processing plants in Toronto. It wasn't last summer, it was the summer before then, wasn't it? Right? So they took a hit in goodwill, right? So if they had purchased a plant where the listeriosis had taken place, okay, then they could say, yeah, our goodwill's been impaired. So if something has happened to, you know, let's say that the street that, or the village that my brother-in-law is opening up the business, things start to go downhill. People start to move out, okay? And he had paid extra money for this restaurant because he thought, wow, this place is booming. I see income potential. This is a good location and whatnot. But suddenly things aren't as rosy as they once were. Okay, and goodwill's been impaired. He can adjust it downward. Okay, write it down a little bit. All right. So in terms of financial reporting, depreciation and amortization are shown separately on the income statement. Okay. And description of computations should be disclosed. That is generally in the notes, by the way. Okay. On the balance sheet, we tend to show each large class of fixed assets. Well, what does that mean? It means we'll show land separately from equipment, from the building. Okay. Use large classes like that. Vehicles, furniture. Okay. And we'll also show accumulated depreciation on each of those large classes separately. All right, so what does that look like for a balance sheet? We'll see the cost, accumulated depreciation, and book value of every major class here, okay, of assets. There's their patents, goodwill. Looks like they haven't been writing down patents or goodwill. Well, first of all, you don't amortize goodwill, and you've got the option of amortizing your patent. You feel that it's indefinite useful life. And that is the end of Chapter 7. Right, so have a good long weekend, by the way. Good luck with the quiz this weekend. Actually, do you want me to take you through the quiz? I could take you through the quiz. Let me just bring this back here. No. So it is very similar to what we just did in class. The first question has to do with depreciation expense, okay, for 4 years using the two methods. Okay, just hold on just a minute. So it's simply a matter of putting in amounts here. There's no financial statement effect. The second one has to do with disposal. Okay, so you buy an asset for $504,000. There's disposal. Okay, so bring the depreciation up to date and then show the disposal here in the second half. Okay, so here we go. And there seems to be a typo too. V2, this should be April 1st, 2011. Okay, I'll be posting an announcement on WebCT about that. Okay. All right, well, have a good weekend then.